welcome to the Deal Flow podcast. Today we have Irwin Boris, head of acquisitions at PCAR Capital, fourth generation family office specializing in small bay industrial and flex properties. With more than 30 years experience in real estate finance and investment, he has participated in over $5 billion worth of transactions across his roles as a lender, asset manager, and sponsor. Irwin has led real estate initiatives for several family offices and serves the Real Estate Advisory Committee at Fordham University, teaches multifamily development and investment. He's known for his focus on cash flow, rigorous due diligence, investor education, and he brings a wealth of experience and expertise to today's conversation. Irwin, welcome to the podcast.
Thank you so much for having me, Michael.
Yeah, it's a pleasure. I think we're going to get a lot of our listeners are going to get a lot of value out of this conversation. So I know I gave you a little bit of a bio there, but I know your path spans accounting, lending, and now leading acquisitions for family offices. Could you walk us through how you got into real estate investing and what kind of drew you into your current focus?
Sure. Yeah, it's easy enough. It's when I look at my family history, my grandparents were immigrants from Eastern Europe, and when they had money, they started buying the buildings out of which they developed businesses in, and they tried to buy the adjoining buildings as well. And then going through school, my father was a real estate attorney, so I got really exposed to it, to development, to different investing. And when I practiced accounting, I worked for back then it was a national accounting firm. But, all these things have been merged, so none of the names mean anything to anybody, but we had a lot of real estate clients. So I did a lot of audits. I got to see a lot of budgeting, a lot of analyses. And then when I got tired of actually looking at numbers, I went to work for one of the firm's clients who still is on the Forbes list, and a very large owner-operator of multifamily and other real estate assets. And they taught me the management side of the business. So I got to see exactly what those numbers meant and really how hard it was to get some of those numbers to fruition. And so I did everything from manage a 20-man union crew. This was in Queens, New York. I had to go to landlord-tenant court and see what kind of games in a tilted system where the tenants had better than 50-50 chance of getting what they wanted. And over the years, I've either worked as a lender or worked on operating platforms. So it's really given me a good mix of a feel of what I'd like to think of best practices, things to run away from, hearing all the stories that people tell lenders, and really trying to figure out what's the truth and what you should depend on in your own analysis and your own due diligence as an owner-operator, investor.
Yeah, no, so great. Now, piggybacking on that, maybe you could tell us a little bit of those lessons that you did learn. So you were on the accounting side, like you said, and then in the management side. What, if you were to pick just a couple of lessons, you've been in this business for now 30 plus years, but a couple lessons that you've learned that you apply in your business today, that'd be helpful.
Sure. It's like you see that disclaimer, in everybody's offering memorandum and everybody's advertisement. Past performance is no guarantee of future returns. Yeah. And hindsight is always crystal clear on what you actually did achieve, where you went wrong, and maybe based on what you missed, maybe you could build a little bit of a better mousetrap on things to take into account going forward. Years ago, when we all underwrote these things, everybody looked at what the IRR, what the projected equity multiple is, and no one really focused on current cash flow. And when you look at from 2010 through 2020, it was really hard to screw up a deal. That trajectory, interest rates were low, cap rates kept compressing, income was climbing, so all the leaky boats came off the bottom of the ocean. And then when interest rates started to move and operating costs started to spiral out of control, especially like insurance and multifamily, a lot of deals had to tread water. And then if you were one of these guys that used a lot of floating rate debt and tried to structure things to make it look pretty on paper, you really got screwed without an interest rate cap. So I find that people that I've tried to help make decisions of whether they should answer capital calls or not, especially on multifamily deals, it's always, I like to find out what their history of was investing. And when they started out, every deal worked. So as they did subsequent deals, I found that some did less due diligence or some did none. They figured they couldn't go wrong. Multifamily was the way to go. And I say to them, did you ever really focus on what the current cash flow is and how that's going to grow? Forget on projected IRR and projected equity multiples, because those can be engineered on paper to get you to invest. And a lot of people said, no, we were always chasing doubling and tripling our money, that we didn't really focus on that because all the prior deals worked out. And in my background as a lender, we did all asset classes. So I saw a lot of hotels. I saw retail, I did office, and we own office in our portfolio. We own some hotels, but we've always had some industrial, or the mothership, as we call it. How we made the money as an immigrant family, it was through manufacturing and importing of textiles. So we were a big user of industrial. So we've been in industrial for a very long time. And the one thing we always look at on the investment side is cash flow. Because if you hold it long enough, you're always going to double your money. The question is, how do you sustain holding it without the ups and downs and the operating costs? And that's why when we look at a deal now, I have to have a good spread between going in cap rate on in-place income and my cost of finance. That'll tell me if I'm going to be able to pay my investors 8 or 9 current out of the box. If I can't pay at least 8% in the first year, I might as well, on a risk-adjusted basis, put my money in treasuries at 5%. And that's really what it looks like. And I guess about 5 years ago when I joined the family, they really didn't have a lot of outside investors. They had some partners. Maybe there were 2 people in a deal, 3 people in a deal. But everybody, the friends and family, let's call it the country club set, kept saying, hey, you do industrial. We like that asset class. How come you never invite people in? So we started a friends and family and cousins plus, and it's continued to attract probably 5 to 7 new investors every year. We don't do a lot of marketing. We don't do a lot of advertising. And unlike some people, we don't need to do a deal to keep our lights on.
Sure.
So for a year and a half, we did nothing when interest rates and expenses were moving till the market settled. And if I said to you, Michael, here's the opportunity, I said, think of it this way. You're going to get 8% in the first year, and rents are going to compound 3% a year. And you say to me, I don't really understand that. I said, all right, take your body weight. Compound at 3% a year for the next 7 to 10 years. You said, oh my God, I got fat.
Yeah.
I'm like, that's how I know the value is there at the end of the day. And because the leases are all either triple net or modified gross, we have no exposure to changes in operating costs. Right. So that's how I know you get 7 years, you get it's a 2 at least. Sure. With slow growth.
Yeah.
And some people say to me, oh, what's a bad deal? I said, a bad deal is I got 8% a year for 10 years and I sold it for my basis.
Yeah. Hey, it's not terrible.
No, it's not terrible.
And it's tax deferred at the very least as well, that 8%.
No. Yeah.
So there's a lot of things you said in there that we want to jump into just because there's some terms and stuff. But I want to just summarize what you said. I think you want to have positive carry, right? You want to have a deal where you're getting cash flow every single year. And it sounds like you've got a pretty high going in hurdle for that cash flow as well. I'm more familiar with multifamily, but it sounds like in industrial, how readily available are opportunities in your space to get a 8% yield in year one? Because I think everyone would be thrilled with that. And I think in a lot of real estate asset classes, that'd be a great going in cash on cash, but it's challenging to deliver that in today's environment, I would imagine.
Yes and no. You're not going to look for primary cities. You're not going to look for stuff by the port. You're going to look at a lot of secondary locations. You're going to look at smaller deals. I'd say probably 20 million and under because the cap rates are higher. And you really have to understand why tenants are in the location. So I'm not chasing deals to put on a corporate brochure. I'm not Blackstone. I'm not B. Reed. I'm not Starwood. I'm looking for blue collar towns where the tenants are tied to the workforce, they're tied to their suppliers, or they're tied to their customers that they sell to. And we've always been able to find that. 3 weeks ago, we closed a 95,000 square foot building in Warren, Ohio. People are like, where's that? I'm like, the middle of the country where a lot of stuff happens.
Sure.
And in that case, we went in on a 9.5 cap.
Okay.
And I have a triple B investment grade rated tenant who's been in the building since 1998. And the seller just wanted out. They've owned it for 15 years. And I think that the market timing worked against them. We closed that. We're looking at another one out in Michigan. This one, we also do some sale leasebacks where you will find higher cap rates. Again, you need to understand the tenant's business and why are they there and how many people do they employ and do you think that their industry is sustainable? And with onshoring, as the big push is now, a lot of these businesses are continuing to grow, especially if you're in certain niches around the country.
Yeah.
But and I'm the guy that the broker calls after the deal has fallen on a contract once or twice. Sure. After it's got scratch and dent, it's dinged up, the seller's been beaten up, and he's willing to take a little less. He just wants certainty of closure.
Right.
Actually, I looked at a deal yesterday for someone, and actually the investor called me and asked me if I looked at if I seen this deal. And I said, yeah, I thought that was from like, was that like in 22 or 23? It didn't trade yet? And he goes, no, it just fell out of contract. So I called up the seller and I made him an offer. So I went up to see it. Then we'll see if we can get it going. But so here you got, investors, a large investor that's going to put up most of the money calling me because they know that we close and how we operate.
Sure.
To be the front person.
Yeah.
And that one, I think
primarily it sounds like a lot of people are calling you or using you as an advisor in some capacity. Is that typically how you get into these deals? Someone's bringing you, the investor sees it, brings it to you, or you typically, it often sounds like you work direct with owner. Like, what's the primary way in which you source opportunities?
we work directly with some owners, especially if we know them. Property management firms are great sources. They know people are looking to sell. We work with all the major brokerage firms. But again, if you're going to go through multiple rounds of bidding, I don't have an interest. I want to give you an offer. If my offer is acceptable, let's just put it into contract. I don't have time, because by the time you go through the first round, the second round, I've already have something else tied up and I'm not focusing on your deal anymore.
Sure.
And some of them have learned that over the years.
Yeah.
But again, if it falls out of contract, I should be the first phone call.
Call me then.
Call me then.
But I don't think there's any deals that are getting done or have been getting done these last few years where they were the first contract. I think there's been, most deals have gone to second or third sponsors before they've closed. Certainly, we have not closed anything as the first contract. It's been where deals coming back around. Maybe we were a third bidder on the first time, and now the first bidder didn't perform. The second bidder is on to something else, and here we are being able to pick this up, and maybe at a lower price than we were at originally. So tell us, it sounds like industrial and flex properties, there's a big focus on underwriting the credit tenant, right? That seems to be a big focus versus maybe some other asset classes where that's not as much of a concern. Maybe
only on a single tenant property, you look at the tenant financials a lot more closely. If you're buying, I think it's something I looked at 2 weeks ago, 550,000 square feet in three, I call them flex parks that are 8 miles apart from each other, and you have 150 tenants, you sort of have credit by diversity. Multi-tenant, shallow bay industrial is the multifamily of the industrial world.
Right. Yeah.
So when the spaces are 2,500, 5,000, 7,500 square feet in much larger buildings, you're not that concerned because A, nobody builds it anymore. B, somebody doesn't pay rent, you get rid of it, you put somebody else in. And sometimes we're finding out that the tenant next door would love to expand. It's very easily re-tenanted.
Yeah. And you don't have, if someone doesn't pay, that's it. They're out.
That's correct.
There's no tenant landlord law you have to deal with. You're just like, hey, you didn't pay. This is my space. So here's your stuff.
It's a lot easier than multifamily, correct.
And it sounds like you also have a big focus on, you said cash flow, which I imagine that also means fixed rate, relatively low leverage. Do you guys have a down the fairway type of deal? Like, what does a down the fairway type of deal look like for you so far as how you finance it, what you're looking for? Agnostic to location, sounds like you can go anywhere. What's down the fairway for you guys?
Yeah, we're agnostic on location, but the location still has to make sense. Do I know someone that manages in that footprint that I have a relationship with that I can depend on getting timely financial statements? Do they have a management footprint for facilities management to help manage the asset? I'm also not buying something in the middle of nowhere that if the tenant goes out of business, I can't backfill with another tenant.
Sure.
But down the fairway, it's a 65% fixed rate financing execution. More recently, the life companies are out there. So you're not getting full-term interest only. You'll get 2 or 3 years interest only. You'll be at a low 6 coupon where we are right now on 7-year debt. And you'd be buying this thing on an 8.5 or better cap rate. Maybe there's some value add. Maybe there's some vacancy in place. Maybe there's the ability to add on another 30 or 40,000 square feet to the building. Maybe there's a lot of green behind that have been converted to surface parking or anything over there based on your site plan. And again, it's at least 100,000 square feet and up, because the small buildings and the buildings under $12 or $15 million purchase prices don't absorb the closing costs and capitalization real well, and that stuff impacts the returns.
Yeah. And you talked about your going in cap rate, and it sounds like you're getting that yield. Is there a yield on cost that you're trying to, it sounds like you're getting a lot of spread day one, and maybe you're also doing some kind of value add, but that value add is in the core component of your business model. You really want to get that day one cash flow, and the value add is really just like a bonus for your
the value add's a bonus, because it's one thing to buy these, and we've held assets 30 years, and we can, and some of our partners are like, what do you want to sell for? Let's just refinance. What do I do with my money?
Can you say that again for everyone listening in the back? Okay, now I'm just kidding.
No, seriously, the hardest thing to do is to get into a deal and close it. And once it's performing and you're getting good, solid quarterly distributions, what's the hurry to sell? What are you going to do with the money? You got a tax problem.
Yeah.
So a lot, like we have one that 5 years is almost up. The loan will mature next year, and everyone's like, we don't want to sell. It has to be upstate outside of Syracuse. The chip factory's going in up there. And we're like, you know what? Let's just refinance and wait and de-risk a little bit. And we like that idea. So that's what we're going to end up doing there. Where I guess more in multifamily, you're going in on a 6 and you're financing on a 6 and you're preying on a value add play with some trajectory. But is there truly a building that's really in need of a value add program? Can you change kitchens and bathrooms every 5 years and new floors?
I don't know. Yeah, I'll talk to my wife. Yeah, I think we can do new kitchens and gas every 5 years, no problem.
Well, I also look at multifamily, when you look at the percentage of take-home income being spent on rent, the numbers 50% or better in some markets, and that also creates a lot of turnover, which creates a lot of operating costs. So I look at multifamily. We'd love to do them for the depreciation, but I can't buy a multifamily deal on a 6 and get it to work.
Yeah. We are seeing, I think, similar in today's market, and I don't want to get too much into this, but we are seeing a lot of deals getting done in the 6 to 7 cap range now. I think brokers will tell you they're in the 5s, but once you actually do the numbers and they actually trade, you're really looking at mid 6s. And we have a deal we're refining right now that I think will, without buy downs, be in the low 5s.
Wow.
For 5-year money, 140 over, when the 5 years at 380. So with the buy downs, we might even hit 5. Right. So even going in, you could have 150 basis point spread between your financing and your going in cap. And then, and then there's a value add. And so there's hopefully some more spread for that, but not nearly the spread that you're getting going in on an industrial deal, which again is you're looking to, I presume, get a low teens IRR. So lower projected returns, maybe than a multifamily value add, but you're getting a lot more cash yield. You're relying on kind of cash yield and debt pay down to drive your returns. We talked about due diligence, tenant valuation, and risk a little bit. Could you tell me a little bit about maybe some mistakes that you've made, lessons you've learned from those? And maybe that's all connected to what you've said about cash flow and fixed rate debt and things like that. But could you maybe point to 1 or 2 lessons that you like, big whammies that you learned in your career that you take with you in every transaction now?
I guess it's always have dry powder for capital needs. It's better to overcapitalize and then season the property for 2 years. You can always return capital to your investors and explain that to them, rather than really try to screw down the model and not call a lot of capital and then have to call it later. It's okay if you call too much. You explain to people how you operate and how we do this, and we do return capital. I said no one likes a capital call, even though it may be warranted. It's just easier to fund it up front. Maybe it hits your first year return or first 2 years cash flow. But if we don't meet it, we return it. Never assume the building's going to stand forever. Unless the building is an absolute triple net where you have no responsibility for the shell or the parking lot. Always assume that in certain locations, the parking lots are going to take a beating from tractor trailers and trucks and weather and snow plowing. Assume you're going to have roofing issues. So plan for semi-annual roof inspections and semi-annual inspections of all your HVAC units. But things like that, we've learned to put that into the leases with it, because the tenants can control their own temperature, that we put the cost of the annual maintenance of the systems on them. Because a lot of times if it's something going wrong, it's something minor at first, and you could change a part or two before you have to spend the capital. So just things that we've learned over the years. And that also touch your tenants often. Because I bought a building from a large fund, But by doing the tenant interviews, I found that the two tenants we really needed more space, and the leasing broker had no idea. The ownership had no idea. You should have working relationships with your tenants, and every couple of months, how's business? How are you going? Is there anything that you think the property needs? Is there anything that we're missing on the outside, grounds, landscaping, things like that? It's a way of having continued dialogue with your tenants.
Okay. So know your customer and walk that factory floor and know what's going on, and then don't be undercapitalized when you're going to war. So to speak.
Right.
Those are very good lessons. I think people also or maybe overestimate how much it affects returns to raise just 5 or 10% more equity and return it in the first 20% of your hold period. Because it doesn't actually affect returns that much. And if it affects the returns enough that the deal no longer works, probably it wasn't a deal that you should have done to start with if you can't raise another 5% of equity.
Oh, that's exactly right. I find that it's always good to have what if or rainy day money. What if you get approached by a tenant who was credit or quasi credit or national, they need a larger tenant improvement package. It's better to have that ability to do it and put that tenant in on a long-term lease and have to think about it and talk to your investors and try to raise the capital and try to borrow it. It just holds back execution of a business plan.
Mm-hmm. Yeah. So you've talked a bunch about triple net and all these terms that have a lot to do with this space that isn't in the housing space, where we improve the property for tenants, but it's a little bit different to the way we execute it. So maybe could you speak to the typical way that these industrial tenants come in? What is the landlord's responsibility versus the tenant, and how does that all work?
Sure. Typical deal is the tenant is responsible for all repairs and maintenance within their space. Landlord is responsible for the building and the roof. Landlord performs.
It's like a great deal. Maybe I could get my tenants to do that.
You think about it, in the multifamily world, you got valet trash, you got amenity fees. You try to push everything off to the tenants whether you realize it or not.
Yeah.
You're billing out the water, sewer, trash.
That's great. Yeah.
So it's like the same thing where
don't forget the resort fee. We got the resort fee, very important.
So here the landlord and the management company will maintain the building, do the landscaping, the snow plowing, and the tenant's got to reimburse for that. But still, if it's capital, if I need a new roof, that's on me. If I have to replace an air conditioning unit, it's on me. And then you have something called modified gross, where there's an existing base year for everything, for taxes, for maintenance, for CAM, and the tenants are responsible for their pro rata share 100% over that base year. And actually, here's the secret. Modified gross deals make more money than triple net deals because the base rent is typically higher on a modified lease than it is on a triple net lease. So you're compounding rent on a higher number plus collecting 100% of the increase in the operating costs.
But you're selling insurance, so like the tenant is getting a guaranteed thing, even though they're paying a little more than that guarantee.
Yeah, so the tenant likes that. Typically, sometimes if you have GSA tenants, their state, or in New York State or some of the counties, sometimes those leases are gross leases, and then you're just building everything in. Right. You pray there aren't any surprises.
There you go. Okay. So the third lesson is make sure that you pray. Get lots of reserves, know your tenants, and pray that everything will be okay. So now, it sounds like most of your capital, most of your kind of investors have been family offices. And so could maybe you speak to maybe how family offices think about investing in real estate versus maybe some other folks like in institutions or just other market players based on your experience now that you've been all over from lender to asset manager, sponsor, and advisor. What's different about family offices versus other groups?
Family offices have evolved where a lot of times they hired money managers, but now a lot of them have grown where they manage their own money, or you'll have what's called a multi-family family office where they pool resources. So they might have a centralized investment officer and accounting staff just to make sure they have proper accounting and controls and also CPL flow. For them, the number one aspect of any investment is preservation of capital. The first rule, don't lose money. Second rule, refer to the first rule type of thing. But a lot of the family offices, they do have some allocation of risk capital where they'll do some more stuff that's on the riskier scale and chase return. But the core is really steady Eddie, coupon clippers, collecting income, certainty of execution. Same thing, we have to have a lot of high net worth individual investors. I have a lot of doctors who write very large checks. And for them, again, they're more focused on income, current income that's coming in quarterly. And They continue to have this money and they continue to put it out because if you're a medical professional, your eyes and your hands are only good for so long. And after that, you still want to drive the Porsche, you still want to go out for those steak dinners, you still want to play golf at the club. So it's about tax efficiency also, where also institutional funds tend to write very large checks. They're not focused at all on current cash flow. They look at IRR because that's how they make their promote off the people that invest in the funds. For them, it's all about asset management fees and internal rates of return. And
Right.
I don't know how some of those funds are buying deals in 5 caps. I'm sure the pref has got to be 6 or 7. They have to pay the equity. I don't know, but they keep buying.
Improve, right?
Yeah.
They're batting.
Well, if you have an evergreen fund, meaning it doesn't expire, or you can hold long enough and ride the cycles, you will make money. But you'll have some sponsors that, if they see the market starting to turn, are going to sell fast because the shorter the hold, the higher the IRR. And sometimes that's done at the investor's expense.
Yeah. Let's lay it right. It looks good on that tombstone, right? Oh, we got a 38% IRR. We held it for 13 months. You know, he gave me like a 1.15 multiple on invested capital. So it didn't really help me. Yeah, no, that makes a lot of sense. It sounds like you definitely have a long-term hold perspective. Maybe could you talk a little bit about, obviously industrial has a lot of tailwinds, right? Presumably with e-commerce and last mile logistics, and I guess the advent of perhaps drone deliveries at some point soon coming, and robo-taxis and all of these technologies that are going to make what you're doing even more and more attractive. What do you see coming down the line? What does your space look like between now and 2030, you think? Any major shifts coming?
I think that with onshoring, you might see some new development of space. I think all this AI, this data center, is going to be everybody's darling. And you find a lot of funds being raised to do that. You look at Anthropic, you look at ChatGPT, you look at Gemini. So everybody's out there, everybody requires data, and everyone needs energy. Like JP Morgan, I saw something in one of the trade publications this week that they're chasing buildings that have existing capacity, existing dual feed megawatts on the grid, because even if it's not sufficient today for what the data center needs, the fact that you have the power, you don't have to go run the lines. It has a lot of more alternative uses. Like the property I looked at yesterday, I have 10 megawatts coming in. I have it's in 2 lines of 5 each, and they're going to upgrade all the equipment. Are they using it all? No. But do I like that? Yeah. Because if you give back the capacity to the utility company, it's hard to claw it back if you need it in the future. And I think in some locations, because of the data center development, I wouldn't be surprised if you're going to see brownouts at peak times for electric. And that's why there's also, I've noticed some people looking for storage to create battery storage centers so they could draw down the power overnight when it's cheap and then sell it back on the grid and make a spread on it, which I thought was interesting. So data centers are going to drive some of it. Whether we actually see a lot of onshoring of manufacturing under the current administration is to be determined. Although I'd love to, as an American, I think we should make everything here. But when you look at the cost of building the factory, getting the equipment, a lot of the equipment we don't make here, and then hiring and training your workforce, and then paying them good salaries, what's the return on investment that you need to justify that capital expense? And what does that do to the cost of the widget you're trying to sell?
Yeah.
It's probably cheaper to pay the 10% tariff or 15% tariff over a long term.
And you got to wait the amount of time it takes to put that all together, and hopefully the environment hasn't changed so that you're stuck with this big capital investment and nothing to do with it.
That's why I would have held off on the corporate tax break under the big, beautiful bill. I'd say after you're open for business, then you get your tax breaks. And we can even figure it out retro. It's like, why give the horse the cart of carrots to eat before it pulls the cart?
Yeah, now I just laying down taking a nap.
Yeah, exactly.
There you go.
I'm going to food coma.
So anything else that, I guess, outside of anything that you like outside of what you already mentioned, data centers and basically energy? It sounds like a big focus here on it. Who's going to have the energy? And I guess energy has been at the center of economic times for forever, basically, but it just changes what that energy is. But maybe tell me about anything else that you want to talk about there.
No, energy is always going to be a need for no matter what we do. I think that we should have continued to look at green energy, which the current administration just nixed even all the 80 and 90% projects, because the data centers are going to need their power. And a lot of people have said that, You're 90% done. Why not finish funding the money and let them pull it online? Are you going to build gas-fired plants? You're going to build coal-fired plants? That stuff that takes time to build. And I don't see anybody running to build these plants.
Yeah.
And so what are you going to do? You're going to buy more power from Canada? We know the story that's going to work out on their grid. But so AI is going to drive some development. AI will probably drive development. If there's fiber in the middle of a cornfield, that's probably the place to put it, because they don't need to be in a central business district or on major roadways and highways. So it might bring some development to more rural locations. But then again, eventually, I think the AI becomes some more software sided and not all hardware sided, in which case then you have excess capacity for some of your data centers. So I don't really know how that's going to play out, but it's interesting to watch. I love playing with Perplexity and ChatGPT and Claude and all that stuff. Doesn't really sound too human, but I understand there's all sorts of prompts you have to feed it.
Sure.
I'm an old-fashioned guy. I can show you. Here's my Rolodex right here. So, that's my CRMs.
That's great. Yeah. I don't think most people even know what Rolodex is. I didn't grow up with. I grew up my parents having the Rolodex on there with the little thing, and then it would all.
You just spin it around.
It was like the Dewey Decimal System over there, but. Yeah, so I think I want to switch gears a little bit to people maybe who are just starting in real estate or considering real estate as a career. As an instructor at Fordham and on the advisory committee, what are the key skills? Because everything's changing, right? Everything that we're doing, it used to be, I started my career when I was an analyst and I just spent my entire time in Excel and PowerPoint. And now what maybe took me a month before, I could just say the words and it just gets generated. So people entering the workforce today or entering college today as your students, and they want to be in real estate, what are they going to do? And what skills should they be developing and thinking about as they enter there?
Well, I think a lot of deals get done on a people level. So you have to have good people skills. You won't go out to restaurants and two people around the table all sitting there like this, not even talking to each other. And so I think you should work on communication skills, and you're going to be in real estate. I think that it's not beneath anybody to take the salesperson's course and the brokerage person's courses and get licensed, because that'll touch on all the aspects, a lot of the keywords. If you have a chance to take the evaluation course, maybe Argus, because everybody depends on it, even though everybody hates it, at least understand how it works and its limitations. Because if you're going in as an analyst or you want to have a career, that's one of the skills. In addition to Excel, you want to know what you know about Argus, even though there are other alternative softwares to Argus. And then I would say you want to work in an environment that gives you exposure to maybe all the asset classes and everything, from the acquisition to the underwriting to the asset management, before, during, after a disposition. So you don't necessarily need to work for a big glamorous name where you're cubby-holed into one specialized aspect. It might be better off to work at an unknown that's very active, that way you can see a little bit about a lot of things. And I find that in some firms, there's a disconnect between the people that do the acquisition and then the people that do the operations and the asset management. It's like the vision changes somewhere along the line. And so if you're working for a firm where you're always looking back to look forward to make sure everybody's on the same page, I really think helps the asset perform. And then if you can get the post-closing team involved during the underwriting process on, is it actually feasible? Is it going to happen? Would also help make a deal work better.
But then you're gonna ruin the beautiful story that we told before we acquired it. But yeah, no, absolutely. That's always a big issue, right? Is the acquisitions team is spinning a story and telling a great story, and they're raising the money and all of this stuff. But at the end of the day, if the ops team can't deliver, they're not gonna have a very long career or very happy.
Yeah, or you're not raising another fund. So you should talk to the ops people. You could tell an optimal and a base case. So you could tell people certain things, and so you'd have a base case, which is based on what we know we have already been able to do. And you can say, but we're going to take it one step further, and here's what we think we can achieve. So you're setting expectations and then saying, in a perfect world, we'll get here.
Okay, great. We're getting a little bit close to the end of our time today. I wanted to just leave maybe one more open question for you to say anything, leave us with any golden nuggets that we didn't touch on from lessons or your career, or anything you want to leave our listeners with that we didn't touch on yet in this conversation.
Sure. I would say that, to me, I always focus on cash flow, because it's the only thing the day that you close the investment, what your cash on cash return is. Everything else Some of what happens afterwards is beyond your control. You can't control markets, you can't control tenants, you can't control fiscal policy. But if the property has always been fairly well leased in its right location, and also one thing we also do, I never didn't mention during the conversation, is we look to buy below replacement cost. Because if I'm buying below replacement cost, the chances are I'll always be full rather than compete with the guy who has the new build, because he's got a much higher basis to achieve a return. Then you'll always be happy. And also look at each investment as if you're going to own it forever. And if it's something you would own forever, it's something worth pursuing.
That's great. Yeah, I think what is there's Buffett or Buffett's Charlie Munger would say you only could buy 10 right your whole life. You think very closely about what those things would be. No, that was great. Thank you, Irwin. I appreciate your time. Thank you for joining us on the Deal Flow podcast, and we'll catch you on the next one. I appreciate your time.
No, I appreciate you having me, Michael. Thank you so much.
Yeah, all right.
Thank you for listening to Deal Flow with me, Michael Pouliot. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.